Well, if you've been following my work at all, you know that Dr. Nenner and I have been doing videos, and we've been doing videos for years. I have had the honor of interviewing him. He's helped me and explained these cycles to me. And these cycles just keep repeating over and over and over again. Now, one of Dr. Nenner's favorite phrases is, I know what is going to happen. I don't always know why. So I'm going to talk about what is happening on my timing model because my timing model is indicating that we in the real estate business are at the end of our rope, that the cycle is completing, and we're entering into a very dangerous time frame. So let me just go into this and let's just talk about my very first slide. And this is my timing model. I've used it before. This is stylized, of course. Now we've been using that cursor and moving it up the model, and we're coming to the peak. Now it's been very, very accurate. It accurately forecast the mid-course corrections. We knew what they were because our model was telling us we should be anticipating a correction when it came. We knew that it was a buying opportunity, great entry point for us, and we knew it was a buying opportunity within a long-term bull market. It also showed us when we should expect the accumulation phase. We got that perfectly, and into the explosive phase. Now, it also told us that we should anticipating the end of the explosive phase and the beginning of the completion phase. And we had an event. That event was in March of 2022 when the Federal Reserve announced that they were going to start taking liquidity out of the marketplace at the bump of $100 billion a month. Now that's over $1 trillion. Now they caused the bubble. They caused the run up in the bonds. They caused the run up in the stocks. They caused the run up in commodities. They caused the run up in real estate prices, all predicted by my model. And that was the why. They put in trillions and trillions of dollars worth of liquidity. And we talk about the what. The what was an incredible bubble, but bubbles don't last. You know, nature hates bubbles, and they all have a tendency of retracing and reverting to the mean. So let me go to my next slide, and let's just talk about what we're talking about here. Now, last week, if you followed my videos, and please, if you like the content, we really like your support by either subscribing and give us a thumbs up. Both would be great. The logarithms of YouTube, just love that stuff. Now, last week we had Charles Smith on. Brilliant analyst. Really can take a complex situation and put it down into a pretty simple location. This is his bubble symmetry. He looked at the bubbles in the past, and this is the .com bubble. It's an interesting thing is that you can see it starts and there's a symmetry to it. It starts and it ends basically at the same level. It's quite an interesting ride in the middle. Now, what this tells him, and this is what we reviewed, was the fact in this bubble, and in particular the housing bubble, is going to retrace. Again, very similar to my work. And he's anticipating that we have at least a 30% level, which would work really well with me because I think that we're going to look here in Metro Phoenix, have a strong potential for coming down to 2020 pricing, 2019 pricing, maybe 2018. You know, the pendulum never stops where you think it's going to stop, always goes further than when you think. But that'd be a pretty significant downturn, and it gives you an opportunity to maybe buy these properties at pretty strong discounted prices. However, Charles Smith thinks that we could retrace all the way back to 2008, the great financial crisis, because he didn't think it unwound enough. In which case, if that happened, we could see prices across the country go down to 65%. And in some places that are having lots of out-migration, they could be even worse. That's the what. That's what we think is going to happen, what our models are showing us. Now, my model's been showing this for a while. That's why I've been talking about the endangered cities like Chicago, Seattle, Portland, places in California, New Jersey, New York, Minnesota, where population is leaving, going elsewhere. Those will be greatly impacted by the completion of the cycle. and Florida, Texas, and Arizona less so, but we're certainly not going to be immune. So we've been talking about doing 1031 exchanges and bringing in funds from Seattle and transferring them here to Phoenix, Arizona. Now that's not new capital. So I have not placed any new capital, which brings in money that's sitting in savings accounts since 2022, when I saw that the completion phase had started. My job as an advisor is to take my clients and protect their capital to my very best, and to try and emphasize where they can make the most money. That's probably not going to happen for another year to year and a half. Then it's going to be an amazing time to be buying properties. Let me go to my next slide and let's just take a look at what is going to happen. Now, again, we're talking about what? So here is Charles Hugh Smith's work. It fits beautifully into my timing models. You can see by his charts where the two mid-course corrections are. They time almost perfectly. You can see the accumulation phase, which is that red arrow and kind of towards the middle, and the explosive phase. But the explosive phase ends, and there's a timing to the explosive phase. That's when I knew that it was ending. Again, when the Federal Reserve announced that they were going to start taking funds out of the economy and cooling it down. Now we're in a liquidity business. My industry, my asset class, as in most asset classes, are driven by liquidity. When that liquidity starts coming out, it is just terrible for our business. Now you can see peak 1 and peak 2. Those are textbook perfect. And then there's the other side, this right side of that center line. That's not so fun. I think that's where prices decline. And you can see then that we've got a timing again. That's the what. That what is going to give us 3 very, very good buys. Now, if you want to get involved with us, you certainly can. So when we buy a property, we buy it for you. It is in your name. You own it. We just advise on it, and you can put it into our portfolio, and we'll portfolio manage it for you. If this is what you want to do, please let us know, because we are taking names, getting ready for this, and trying to work with our clients as to what is going to be best. So you're welcome to consult with us on that. This is the what. Let's continue just a little further here and let's see where it goes. Now we want to start talking about some of the why. So we know what is going to happen. Here's some of the signposts as we see coming along. We're getting to the point where we've got interest rates that are at the point that we haven't seen for 20 years, 25 years. So I just got this morning from Zero Hedge. We're talking about the average 30-year mortgage is now running just under 8%. Well, this is onerous. And of course, if you don't have great credit, if you're in a 660 or 640, which is okay credit, you're going to pay more than this. If you're buying an investment property, you're going to pay more than this because they're going to charge a premium. If you're going to buy a vacation home or an investment property like a VRBO or a vacation home, you're going to pay 8.5 to 9%. This is what's stopping the market. This is the why. So this is fitting right into our timing model. Here's another one. So again, another why. Mortgage applications are dropping to all-time levels. This you have to go back to 1996 before you can see this little applications. It has dropped to that level of activity. This is very, very bad for lenders. So you have to understand, banks make a lot of money by originating mortgages. When you don't have mortgage origination, you start losing lenders, you start losing loan officers, escrow officers, title companies, appraisers, home inspections. When people close on their homes, they all want to decorate them. So it means all the flooring companies and furnitures and window treatments, landscaping. This is going to slow our economy down to a real low level. And we're not even talking about the real estate commission, which is very near and dear to my heart. Let me go to my next slide and let's just take a look at that. And here's the results. Again, why? Just got this too from the National Association of Realtors. U.S. pending home sales at the lowest level ever. And we did, it is a little deceiving because we did get to the same point that they had during the COVID close down. So, this is when it stopped. So we're at that level. It's never, ever been lower than this before. This is just terrible. And this is the why. So we're starting to see that we're coming into the completion. This is part of our completion. Now, if we can help in any way, I know that we have lots of investors that have cash to be put on to put to work. We're very, very good. Our cash flows are excellent. We have here in Metro Phoenix, we have great decades-long growth that's coming here. It's just an amazing place to be. It's not yet, but if you'd like to get together with us, if you'd like to start talking to us about, talking to your financial people, talk to your spouse, your financial advisor, your CPA, your tax accountant, we're more than happy to do this because there's lots and lots of advantages. Just give us a call at this number and we're going to make a time that we can schedule something where we can meet you. My very best to you. Bye-bye now.